In this video, we're going to be looking at 3 different dividend stocks that are all trading near their 52-week low. And all 3 of these dividend stocks have really nice starting dividend yields of around 5 to 6 to 7%. And the first company we're going to be looking at is Intel, stock ticker INTC, currently trading at $28.43 per share. Now, the entire year has been a very difficult one for INTC. We can see year to date, they're down about 46.58%. They were trading as high as around $55 per share. We can see a huge decline in the share price. Let's go ahead and jump into our stock valuation spreadsheet to see if we can find the intrinsic value. And this is what we're going to be looking at for all 3 of these dividend stocks. We're going to be looking at 4 different valuations. We'll look at Graham's valuation, a discounted cash flow, a multiples valuation, and a dividend discount model. And all 4 of these valuations will roll into our output tabs. Let's go ahead and jump back over to our stock screener. If you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. But okay, let's go ahead and come up here and we will plug in the stock ticker INTC and hit enter. And you can see all of this data is going to automatically load in. We're currently looking at a 500-day change. So again, you can see how drastic the price decline has been. Come over here and look at the dividend data. We can see they're paying out $1.46 per share, which gives them a really nice starting dividend yield of about 5.14% and a good payout ratio at about 44.2%, meaning that dividend would appear that it is safe for now. We can see the 20, 50, and 200-day moving averages all currently down. Analysts currently have a target price of $31.53%. And the beta is sitting at 0.74, so you shouldn't see a whole lot of volatility. Now, you do have to keep in mind, they do conduct themselves within the semiconductor sector. There's a lot of competition going on within that industry right now. But let's go ahead and move forward, and we'll start by looking at Graham's valuation. And this is a valuation model invented by Benjamin Graham in order to calculate intrinsic value. And here's the formula he lays out for us right here. So we can see the different variables that we need. We have their earnings per share automatically plugged in. We then apply a growth rate projection, and people aren't projecting much growth over the next 2 to 3 years, but they are expecting the company to begin to grow again in about around 2025 or 2026. So I am applying a low growth rate projection of about 2. I think that's in line with analysts. And then we have the current yield on AAA corporate bonds. And that's actually a number that got up pretty high over the past few months. We can see it was sitting as high as 5.12, but it's come down to about 4.37, which does help the valuation a little bit. We can see it gives it an intrinsic value of $29.36 per share, which is very close to that current trading price. Now, at the beginning of this year, the current yield on AAA corporate bonds was as low as 2.8. So when that's the case, we can see that pushes this intrinsic value all the way up to $45.82 per share. So that definitely plays a large role into this valuation. But let's go ahead and keep moving forward, and we'll look at our discounted cash flow. And in order to perform this, we need to project a growth rate to the future free cash flows for the company. So you can see I plugged in some of the historical free cash flow for INTC. They had quite a few years of really good free cash flow growth, then a huge decline in 2021. Now, this is kind of a difficult discounted cash flow because they're not projecting hardly any free cash flow growth for the next 3 years. So what I've done is I projected a growth rate of 0% for the next 3 years of future free cash flow. And then you can see I made a note over here. We're projecting 4% growth moving forward after that, and 4% to the terminal value, which is the sum of the future free cash flows past the year 2030, as we can see right here. I then took the present value of those future free cash flows and added them together, added INTC's cash and cash equivalents, and subtracted out their total debt to get their equity value, then divided by the number of shares outstanding, and this gave me a discounted cash flow price per share of about $36. So again, a little bit higher than that current trading price. Let's go ahead and move forward and look at the multiples valuation, and the idea is we should be able to value INTC based on how the market is valuing companies that are similar in structure using a multiple such as the price to earnings multiple. So you can see it's really important to pick good comparable companies here, but we're taking their stock price, dividing by the earnings per share to get that price to earnings multiple. We then take the average price to earnings multiple for this company, multiply by INTC's earnings per share to get that intrinsic value of $40.87. So what does this mean? Well, we can see the average price to earnings for these comparable companies is sitting at 12.61. If we jump back over to our stock screener and scroll down, we can see INTC sitting at 8.77. That's a little bit of an indicator that they may be undervalued, but let's go ahead and move forward and look at our dividend discount model. And this is an important valuation for me because I'm a value dividend investor, and this values a company based on how much they pay out in dividends and how much that dividend is increasing over time. So you can see I plugged in the quarterly dividend payouts over the last 5 years. And this allows us to see our year-over-year growth rates of 5%, 4.76, 5.3, and 5%. That gives them an average growth rate of right at 5%. So that's a pretty good dividend growth rate overall. Moving forward, I'm projecting a growth rate of about 4.75. It's I think it's possible it could be closer to 5 in the long run, but after applying a discount rate of 8.5, we come to a dividend discount model price per share of $40.78. Now, anytime you do have a somewhat decent growth rate, two things you want to look at is there going to be growing free cash flow. And as we saw, we don't expect a whole lot of free cash flow growth for the next 3 years, which is a little bit concerning. But when we jump over to the stock screener, look at this payout ratio, 44.2%. I do think that will be sustainable moving forward, even with 3 years of low free cash flow growth. So when we go ahead and jump over to our output tab, we can see our 4 valuations. Grams at 29.36, multiples at 40.87, discounted cash flow at 36, and dividend discount model at 40.78. So you can see multiples, dividend discount model, discounted cash flow, all in the upper 30s to lower 40s. Grams valuation is going to drive this valuation down just a little bit. We can see here we come to an intrinsic value of $36.76 per share. Now we always want to apply a margin of safety as value dividend investors. So let's say we apply 20% margin of safety. Based upon that, you can see our acceptable buy price for this company is about $29.44 per share, meaning now may be a good time to consider adding shares to this company. If you do consider adding shares, keep in mind, I don't think this is going to be a good short-term play. I think it's going to take time for this company to get back to where they want to be, but you do get in at a good starting dividend yield, and hopefully you'll see some dividend growth over time as well. The second dividend stock near a 52-week low that we're going to look at is a company I analyzed not too long ago, and that's Verizon Communications, stock ticker VZ, currently trading at $37 per share. Now, this was a company before this year that was considered a very safe dividend investment with a good starting dividend yield, but we can see year to date they're down almost 30%. Now, there's a lot to take in about this company. If we jump in over to the income statement, we can see that their revenues have been stagnant for quite some time now, but something we do like about the company is they've been increasing the amount they pay in dividends for 18 consecutive years, and they've also been paying dividends for 22 years in a row. So let's go ahead and jump into our stock analysis spreadsheet. We'll go ahead and zoom out right here. We'll zoom out just a little bit more, and as we can see, I've already plugged in Verizon stock ticker, so we have our data loaded in. Here's our 365-day change chart. Again, we can see a huge decline. Had a little bit of a bounce back recently, but it's dropping back down to those lows. Come over here, we can see they have a dividend payout of $2.61 per share, which gives them a really good starting dividend yield of 7.04%. Come down here, we can see analysts currently have a target price of $45.30 per share. Institutional ownership decent at around 63%, and a very, very low beta of 0.38. So you really shouldn't see a whole lot of volatility out of this company. 20, 50, and 200-day moving averages all down quite a bit. But let's go ahead and look at Grams valuation. We'll go ahead and zoom in over here again, and we can see the variables we've plugged in right here. Okay earnings per share, a low growth rate projection, which is no surprise if you know anything about Verizon. Then, of course, we plugged in the current yield on AAA corporate bonds, and we get all of this. We come to an intrinsic value of about $46.32 per share, quite a bit higher than that current trading price of $37. But we'll keep moving forward and look at our discounted cash flow model. And again, you can see the years we've plugged in right here. Decent year at 0.71, really good year here at 32% free cash flow growth, but we did have a big drawback fairly recently. Now, moving forward, I'm projecting a growth rate of about 3.25% for the future free cash flows for this company. That's around the range a lot of analysts expect it to be. So I projected that to the future free cash flows and the terminal value, found the present value of those future free cash flows here and added them together, added the company's cash and subtracted out the total debt to get that equity value. Once I had that, I divided by the shares outstanding and again, came to a discounted cash flow price per share of about $44, pretty close to Grams valuation. Now, when we jump over to the multiples valuation, there's really not a whole lot of companies that are quite the size of Verizon, and I don't think there's a lot of good comparables. Obviously, we have AT&T as probably the best comparison, but it's not really appropriate to do a multiples valuation when you only have one comparable company. So because of that, we're actually not going to be using this valuation to calculate intrinsic value. Instead, we're going to go ahead and jump over to our last valuation, the dividend discount model. So again, you can see here I plugged in our quarterly dividend payments so we can see how much they pay out each year. We can see they have had lower dividend growth, but keep in mind they have a much higher starting dividend yield. But the average growth rate was right around 2%. So moving forward, I'm projecting a growth rate of 2.2% and a discount rate of 8%. And again, we come to a dividend discount model price per share of right around $45 per share. So you may be wondering, why did we get such a good valuation when the growth rate is so low? But again, keep in mind, a lot of this has to do with that really good starting dividend yield, starting at around 7%. Let's go ahead and jump over to our output tab, and we'll see the three valuations that we did all very close to each other. Grams at 46, discounted cash flow at 44, and dividend discount model at 45. So when we average these three together, we come to an intrinsic value of $45.23 per share. So if we want to apply a 20% margin of safety, based upon that, we can see our acceptable buy price is about $36.19. So it's not quite in that buy range, but it is getting very close. If you're a little bit more aggressive, let's say you want to apply a 10% margin of safety, your acceptable buy price would be around $40 per share. Now keep in mind, again, don't expect to see a whole lot of growth out of this company in the future, but I do think it will start to reflect that intrinsic value over time, and you would be getting in at a really good starting dividend yield. So if you only have a few more years before you plan to try to retire off of dividends, this may be an opportunity that you want to take advantage of. If you have a long time horizon, go ahead and consider the pros and cons of this investment. But let's go ahead and look at our last company. And the last dividend stock we'll be looking at is VF Corporation, stock ticker VFC, currently trading at $28.67 per share. They're up slightly over the past month, but they've been hit extremely hard over the past year, down about 62.82%. They were trading as high as $77.32 per share, but now they're back down close to that 52-week low. Now, there's been a lot of drama around this stock as of late. They recently had their CEO leave, and there have been a lot of institutional investors downgrading this stock to a lower price point. But something we do like about this company, they've been increasing the amount they pay in dividends for almost 48 consecutive years. They're becoming close to becoming a dividend king. So let's go ahead and jump into our stock analysis spreadsheet. You can see I went ahead and plugged in the stock ticker VFC right here so we can see all of this data. Dividend is $2.04 per share, which gives them a really good starting dividend yield of 7.1%. Now we can see the payout ratio is extremely high. We'll come back and talk about that just a little bit later in the video. Analysts currently have a target price of $33.52 per share. Institutional ownership was quite a bit higher than I was expecting, but the beta is sitting at 1.39, so you will see a little bit more volatility in this stock. Now jumping into Graham's valuation, we'll go ahead and zoom in right here. We can see we've plugged in all of our variables, and because of the low earnings per share, we do come to a low intrinsic value despite a somewhat decent growth rate projection from analysts in the coming years. But we can see intrinsic value of about $21.75 per share. Now jumping over to our DCF model, we can see it's been a kind of a wild ride for their free cash flow over the past few years. A really good year back here, somewhat steady growth here, then a huge decline and a huge increase in 2020 back to where they were around 2018 and 2017. Then most recently in 2021, again, they saw a huge decline in free cash flow growth. So it is a little bit harder to project what the future free cash flow will look for this company. So I did go with analyst expectations of around 8%. That's also close to their average growth rate of 5.72%. So I projected that to the future free cash flows for this company and the terminal value. Again, found their present value and added them together here, added their cash and subtracted out their total debt to get that equity value. I then divided by the shares outstanding and came to a discounted cash flow price per share of $23.80, pretty close to Graham's valuation once again. Now jumping over to our multiples valuation, you can see we have a few different comparables for this company, and the average price to earnings for them is about 12.55. So when we jump over to the stock screen and look at VFC's price to earnings of 26.62, that really kind of makes me feel like this is still a company that is overvalued despite the huge decline in their share price. You can see we came to a really low intrinsic value of $13.56 per share. Now you can argue that maybe they trade at a premium because of their history of paying out dividends for such a long time and their nice starting dividend yield, but I'm not sure that stock price is currently justified by that. Now moving over to the dividend discount model, we can see they have had a few good years of dividend growth at 8.86%, 11.63%. The last couple of years have been a little bit slower, around 2%, but that's still an average growth rate of 6.15%. So when we project a growth rate to the future dividends of 3% and a discount rate of 8.5%, the dividend discount model gives us a price per share of $37.45 per share. Now there's something we really need to take note of that I said I'd mentioned just a little while back, and that payout ratio for this company has gotten extremely high. That is a huge red flag, and for that reason, the dividend discount model is really not the best way to be valuing this company because that dividend is not safe. So we'll go ahead and remove that from our valuation, and when we do that, you can see our intrinsic value gets really low, as we can see right here. We've got Grams at 21, multiples at 13.5, and DCF at 23.8. We had a decent dividend discount model valuation, but it's really not justified because that dividend will likely not be sustainable sustainable in the future. So we come to an intrinsic value of about $19.70 per share. When we apply a 10% margin of safety, we can see our acceptable buy price for this company is around $17.73 per share. This is not a dividend stock I'm going to be considering for my portfolio right now. I like the history of dividend growth over time and the starting dividend yield, but at its current payout ratio, I don't think this dividend will be sustainable, and it's at a huge risk of being cut. So there you go. Those are 3 dividend stocks near a 52-week low. Go ahead and let me know what you think of each of these 3 stocks in the comments down below if you plan on buying or selling. If you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. So with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.